The $1 billion settlement is the largest ever for a shareholder class action lawsuit against a U.S. bank. It is part of a series of legal troubles that Wells Fargo has faced in recent years for its misconduct and negligence in various business lines. The lawsuit was filed by investors who bought Wells Fargo common stock between February 26, 2014 and September 20, 2016. They claim that the bank misled them about its sales practices, risk management, and compliance with consumer protection laws. They also alleged that the bank inflated its stock price by engaging in widespread fraud and abuse of its customers, such as opening millions of unauthorized accounts, charging improper fees, and forcing unwanted products on them. The settlement was announced in December 2022 and received preliminary approval from a federal judge in San Francisco in January 2023. It is expected to be finalized later this year after a hearing to determine its fairness and adequacy. The settlement amount represents about 4% of the bank's market capitalization as of January 2023. The $1 billion settlement is not the only penalty that Wells Fargo has paid for its wrongdoing. In 2018, the bank agreed to pay another $1 billion to the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency for its lending abuses in its auto insurance and home loan businesses. In 2022, the bank also faced a record fine of more than $1 billion from the same regulators for failing to remediate the harm caused by its previous violations. The settlement is a significant victory for the shareholders who suffered losses due to the bank's misconduct. It also sends a strong message to other financial institutions that they will be held accountable for their actions and that they must treat their customers fairly and honestly. The lawsuit alleged that Wells Fargo and its former CEO Timothy Sloan misled investors about the bank's progress in addressing regulatory issues and customer complaints. The plaintiffs claim that Wells Fargo violated the Employee Retirement Income Security Act, ERISA, by investing in its own stock through its 401k and employee stock ownership plans, even though the stock price was artificially inflated by the bank's fraudulent practices. According to the lawsuit, Sloan and other executives knew or should have known that Wells Fargo was engaged in widespread sales abuses, such as opening millions of unauthorized accounts, forcing customers to buy unnecessary car insurance, and charging improper fees. These practices resulted in regulatory investigations, fines, lawsuits, and reputational damage for the bank. However, instead of disclosing the truth to the public and the plan participants, Sloan and other defendants made false and misleading statements about Wells Fargo's financial performance, business model, culture, and compliance efforts. They also failed to take adequate steps to correct the misconduct and prevent further harm. By doing so, the defendants breached their fiduciary duties to the plan participants, who suffered losses when Wells Fargo's stock price plummeted after the scandals became public. The plaintiffs sought to recover damages for the plan participants and to remove the defendants from their fiduciary positions. The lawsuit was one of many legal challenges that Sloan faced during his tenure as Wells Fargo's CEO. He also testified before Congress several times, facing harsh criticism from lawmakers of both parties who questioned his ability to reform the bank and restore trust among customers, employees, regulators, and investors. Sloan resigned abruptly in March 2019, saying he had become a distraction for the bank. The settlement comes after Wells Fargo has paid billions of dollars in fines and penalties for various scandals involving auto insurance, mortgage practices, fake accounts, and more. Here are some of the most notorious examples of the bank's misconduct over the years. In 2016, Wells Fargo admitted to creating 1.5 million fake deposit accounts and more than 500,000 fake credit cards without customers' permission, in order to meet unrealistic sales goals. The bank fired 5,300 low-level employees and agreed to pay $185 million in fines and $142 million in restitution to affected customers. In 2016, Wells Fargo also agreed to pay $20 million in fines and $10 million in restitution for illegally repossessing the cars of hundreds of service members without proper court orders or interest rate limits.